continuing in this video series, How to Buy a Business. We have talked about so much so far. We've talked about identifying the business that you want to buy. We've talked about fiscal and financial due diligence. We've talked about the deal and its structure. And in this video, we're going to be talking about closing the transaction. How do you actually get this deal done so you can start working? Well, there's lots of components to that. So let me jump right in and start at the beginning. We need to understand how you're buying this business, not what money you're going to use, but are you buying it as an individual or as a company? And so there's different levels of that. And I want to talk to you about each one because they provide a level of protection for you as you go through the process of acquiring your company. First one is as an individual. That's obviously the simplest method. You and your social security number represent the buyer of the business, and it's all listed under your individual name and social security number. I want to tell you that this is the highest risk and exposes you to more liability personally than any other structure. So hopefully I've just scared you enough that you don't consider buying it as an individual. So I do want to talk about that though, because it is a possibility that you could buy as an individual. The second is that you buy it as a company, an LLC or a corporation. So what is an LLC? It's a limited liability company. It is, for all intents and purposes, it's a separate entity and organization that allows you to own and operate businesses for the production of profit that protects you from liability. So let's think of it this way. When you set up an LLC or a corporation, you are literally transferring the liability from yourself personally into that company. It is exposed only to the level of assets that are listed within that LLC. No more and no less, typically. It provides the greatest level of protection. Now, I lumped these two together, LLC and corporation, because you can file as an LLC that files it as an S corporation. Subchapter S is a tax provision in the tax code, or a C corporation, which is another level of protection that separates the company from you almost exclusively, creates its own entity. I like to describe it. It's like its own living, breathing organism, but it's also responsible for its own taxes. It's responsible for its own life and liberty and pursuit of happiness and all of those things, even though you own it. So you have a couple of different structures here. You have an LLC, which for 90% of the businesses that are going to be acquired and operated in America today, an LLC is sufficient and is the right structure. You may choose an S corporation to file as an S corporation that provides some additional tax advantages for you as you move through and run your company, or you could choose a C corporation. So better for tax planning and better also for long-term growth to have a entity that buys the business. Now, how do you form all of this legally? Well, you need to create your entity through your Secretary of State, through your Department of Corporations, through whatever state organization or division runs corporations for you. So in our state, it's a Secretary of State, but yours might be called something a little bit different. You also need to file an SS4 with the IRS and obtain an employer identification number so that you can acquire this. Now, in some cases in your acquisition, you're taking the name, the filing, and the EIN from the seller in the acquisition. So just make sure that your accountant and your lawyer are involved in your conversations as you move forward. So, but you need to go to the IRS. You can go to irs.gov and apply for an EIN, employer identification number, online as well. It's very easy for you to do. And then you need to go to your bank and open a bank account. One of the challenges that business owners, especially new business owners, have is that they merge their accounts into one. They run their business out of their personal and their personal out of their business. This creates lots of complications for your CPA, for the tax preparation, and for truly accounting for how the health of the business is doing financially. So you need to open a separate bank account, go to your bank. They'll know exactly what to do. They'll ask for some documentation, and you open an account that all of your revenue and expenses are run through that bank account separately, and you pay yourself as an employee from your business. And then finally, you need to register this new entity with your state. Like I said, the local agency or the state agency could be Secretary of State, Department of Revenue, could have a name like that. And on our website, we have a whole list of all 50 of the state's registration agencies that you can access so you know exactly where to go. So that's how you form your entity. Well, what legal documentation do you need? Well, I want to stop right here and say that smart acquisitions are done with smart attorneys. So if you're thinking about buying a business, you should be seeking out the advice of an attorney in your area that can help you prepare the kind of documentation that you need. And let me list them for you. The first one is an asset purchase agreement, or APA. The asset purchase agreement is the document that talks about what assets from the organization you are going to be acquiring in this purchase. The second is a non-compete agreement, because you don't want the seller of the business that they're selling you to the next day open the exact same business and now is your competition in the marketplace. So you need a non-compete agreement that prevents the seller from competing with you, the buyer, after the close of the sale. You need a bill of sale. This describes the terms and conditions of the acquisition and gives you the purchase price. You need an assignment of lease if that is appropriate. If the space that the business is operating in is in a lease, you need an assignment of lease to move that lease over into your name. You also need assignment of contracts, right? So let's say you have contracts with vendors and suppliers that are operating with you based on the terms of that contract. You need assignment of those contracts in order to move those relationships over to you and make sure that they get paid correctly and you get paid correctly. We need a transfer of IP and branding. Your seller needs to transfer all of that intellectual property and branding information over to you with logos, designs, color schemes, all of those things that can be promoted after you're the owner. And then finally, there's going to be a promissory note. If the owner is financing this business for you, you need to have a note in place that describes how long you're paying him, what the monthly payment's going to be, how much interest you're going to pay, and what the terms are if you were to default on that note, what they get to do. Do they get to take the business back? Do they get to charge you more money, or whatever have you? So that's how the business is acquired in terms of those components. And then finally, I said this just a moment ago, and I'm going to say it again. You need to close with an attorney, because every line in the contract matters. And your attorney is responsible for protecting you from future liability. We want to make sure that we wrap a fence around you and protect you as much as possible in the acquisition that you're making. It also ensures that all of the assets are transferred to you legally, that you have a legal claim on them, that there are no hindrances or encumbrances on those assets that could prevent them from being transferred to you. Now, it also helps you avoid a few things. It also helps you avoid undisclosed liabilities. It helps you avoid sales tax problems or payroll responsibilities or warranty or return issues that might be related to the business and the product that you're buying. The seller's non-disclosure of those things could cause you some potential problems. With an attorney, they're going to help you make sure that those things are all taking place. So this is how you close the transaction. It's going to be closed in a signing. You're going to transfer money to the seller. The seller's going to transfer all the assets to you. And then you have your day one as a new business owner. So exciting. We're going to talk about what to do on day one leadership in the next video. I'm so thankful for you, and I really hope that your business acquisition strategies prove fruitful for you.